今日のプレゼンテーションですけれども、商用車グローバルトレンドと地域洞察ということで、私、ミッドヘビーコマーシャルチームの、東京におります佐々木と申します。で、今日は我々のチームのリーダーのアンドレ・デイビスと、ミッドヘビーの中で、長期予測を取りまとめておりますグレッグがアメリカからそれぞれレポートをいたします。で、今日は最新の商用車のマーケット状況をお分かりいただける内容となっておりますので、よろしくお願いいたします。Andre, I'd like to hand over to you.
Thank you very much. Hopefully everybody can hear me. Really want to thank everybody for joining today. It's great to have this opportunity to speak. What we've got for you today is a varied agenda. So I'm speaking to you today from outside of Washington, D.C. in the U.S. We have kind of a two-part presentation together with Genette from our team, followed by questions and answers, which will be moderated by my colleague, Miki Sasaki. The first part of the presentation will focus on economics, industry trends, including the short term, as well as our thinking about tariffs currently. Some of this material reflects what we recently published, which was released in August. The second part of the presentation is going to be taking a longer look, looking ahead at some technology and powertrain issues, specifically at the energy transition, and previewing some of the findings from our upcoming Reinventing the Truck 2025 study, which is yet to be released. With that, I'll go ahead and get into the material. One moment, please. All right, I think everybody can now see the economic outlook. This is the first thing that I'd like to show you. And there's a couple key points on this slide. One of the main points is that we do expect economic growth to accelerate in the medium to long term, globally to an expansion rate of around 2.6 or 2.7% in real terms annually. Also, it's obvious that much of that expansion is going to be carried by some of the faster growing markets around the world, including India and China. But in the short term, there's a few special factors that are also worth mentioning. The current year is expected by our economics team to see a growth rate of only around 2.3%, which is one of the slowest growth rates other than the COVID year 2020 that we've seen in the past 10 or 15 years. That slowness reflects some of the uncertainty in the world today. But in addition to that, it also reflects a period of high inflation, as well as the consequences of high inflation, which have been a period of high interest rates in many countries as central banks have sought to combat the inflation. Over time, that has begun to grind down a little bit household purchasing power, some business investment decisions, etc., globally. And that is one of the factors that is bringing down the growth rate in the current year. At the same time, this growth rate is in some respects stronger than what it could have been. We have seen some positive developments in the first half of 2025. And those include actually higher growth rates in several of the regions, including the US. Those include some delay in visible tariff impacts across the markets, not just in terms of economic activity, but also in terms of price impacts on products. And finally, we've also seen lower commodity prices, or actually lower oil prices. I need to be careful. Lower oil prices than we had thought we would see at the start of the year. Obviously, that impact is positive for some countries and negative for others, but net globally, we believe that's a positive. So there are some reasons to see some optimism, even in the slow growth rate that we're seeing this year. On the next slide, you can see two indicators. Those indicators are, on the one hand, inflation rates, and on the other hand, you can also see unemployment rates. And the big picture here in terms of inflation is that after a very high period across most of our major markets, the high rate of growth in prices is slowing down. The data here are quarterly. That last data point you see that is orange, it is actually the fourth quarter of 2025 forecast. It is not the last actual date. So with your eye, if you sort of look a little to the left, you'll see where we are now, which is the third quarter. But the bottom line, though, is that really it's a story about falling inflation, which will support lower interest rates, is already supporting lower interest rates in many countries, and is expected to support a further lowering of interest rates as time passes this year and next year. There are some markets where maybe the trend is not quite as positive. For example, United Kingdom or maybe the US, where there's a little bit of risk, but overall, it's a positive trend. Similarly, when we look at unemployment or employment at the bottom, we can see that the trend is broadly improving, and there has not been a big, any kind of a big negative jump that would be a great concern. The final slide that I would like to show is the purchasing manager indices. Hopefully you can see that now. This is a measure of, you can kind of think of it as a measure of business confidence. It's based on a survey of many company representatives, manufacturing company representatives, conducted by our company and reported by our company. The data here are through July of 2025. August data are beginning to be available, but they're not shown on this chart. The way to read this chart, if you're not familiar with it, is values of 50 or higher than 50 show an economic expansion, an increase in activity of orders, production, all of those things. Whereas values below 50 show a contraction. And the takeaway here is that after a very strong period of economic activity in sort of 2022, we've been in a period of weak economic activity for most of the major regions for several years now. In 2025 so far, what we've seen is that the Japanese economy, manufacturing industry specifically, still remains a little bit weak. We've seen China and the United States, for their part, remain around that 50 mark, kind of in a neutral area, which is very much consistent, I think, with what we're seeing in China and the United States in terms of economic growth. It's sort of not strong, but it remains positive. And then finally, the bright spot here is really Europe, where we've seen the European Union come back from a contractionary reading to starting to get very close to expansion again. And again, I think just to bring this back to the first chart on GDP growth that we shared, again, this is about, it's a weak year in terms of the economic expansion, but there are bright spots. There are some good stories. There are some signs of strength beneath the surface. And of course, manufacturing drives a lot of freight, which drives our industry. So let's take a look at the next slide, which starts to show the truck forecast. So there'll be two global overview slides. The one that you're looking at now should be the seasonally adjusted annualized rates. It has two trends. One trend is the world including all of the markets. It's basically the global truck trend. It's on the left side. And you can see that it finished the 2024 around 3 million units annualized and has been weakening slightly as 2025 has progressed. Because mainland China has such a large share of the world total, we also track a world total without China. China, for its part, by the way, has been quite stable. So the world total without China is showing a little bit more weakness. That's that orange line on the right scale, showing a little bit of a greater decline than the world with China. And really, several of the regions have been showing a decline, but there are some that remain positive, both compared to the previous quarter and also compared to the previous year. And those three are at a very modest level, it's mainland China, but more strongly South America and also Middle East and Africa. So perhaps if you see that slide in the year-to-date, when we go to the next slide, it's not surprising to see that our forecast for the full year for the truck market, and this slide shows demand for vehicles above 6 tons gross vehicle weight globally. So this is new registrations or sales, whatever your preferred term is. It's no surprise, perhaps, with that sliding annualized rate that our global outlook is for a decline in the global truck market in 2025 compared to 2024. And even though there are some bright spots, and even some markets that are trending up, that those trends are not strong enough to balance out the weak markets. The bar charts on the right give a little more detail. The one on the top just shows you the growth rates if you'd like to see what those growth rates are actually for the world. But the one on the bottom right shows the annual actual and forecast growth rates by major region in the truck market. And so when we look at 2024, you can see several that have a negative orange line, sort of that's that 2024 weakness. You look at North America, you look at South Asia, you look at Europe. This year, it's fewer. It's only Europe and North America, but they're larger, and those are large regions. So it's really the volumes in those regions that are bringing the globe down. I'll say a little bit more about them in just a second, but I just also want to finish on a positive note. Looking at 2026, we do expect both those two weak regions as well as others to accelerate, bringing the market back to higher levels, and then further we see further growth ahead in 2027, and strong health in the industry overall through the remainder of the decade and the start of the 2030s. Okay, I've been speaking now for about 12 minutes or so. I'm going to spend just a few minutes and give some highlights of the major regions. And then I will finish by covering North America, where we have some special questions related to the forecast this year. So when we go to the next slide, which is the first of the regional overviews, the order here is really trying to look at some of the bigger export destinations around the world, and then finishing up, as I said, with a look at North America. So one of the major destinations where exported vehicles go out of Japan and as well as out of other markets is South Asia. The South Asian region is about 3/4 represented by India, which is obviously the largest market there. But there's also other significant markets which are significant export destinations, of course, including the ASEAN markets, if we think about some of the bigger ones like Thailand, Indonesia, Vietnam, as well as Oceania, the largest market of which is Australia. So it's really varied. And the growth drivers are also quite varied right now. So this slide shows some of those growth drivers, and the colors corresponding to the part of the graph. So you've got a bit of a summary here on buses in red, medium duty trucks in orange, and then finally heavy duty in blue. But really there's a couple key messages. I mean, one key message is we are expecting the Indian market to grow in 2025 and in 2026. that reflects back on those strong GDP growth numbers forecasted by our economics team, which is, of course, driving a lot of activity and a lot of freight. There are also structural reasons why the Indian market is very strong right now. There's an extensive infrastructure investment going on, a great deal of road construction. And that's actually reflected in our sort of long-term view for the region, which you can see here in the blue. We expect the share of heavy trucks to remain significant and actually continue to grow as those investments take place. But another structural reason really relates to some of the legislation and specifically tax laws. We believe that the reform of the tax system and specifically the simplification of the GST system, more of which is scheduled this year, will be another factor boosting the market in India this year and next. Elsewhere in the region, if we look at Indonesia and Thailand, we are seeing a challenging market environment right now related to some developments in global commodity prices, as well as uncertainty around international trade and political factors. But again, just the way this plays together, those positives in India sort of outweigh some of those negatives across the region. The next two slides highlight some of the smaller regions around the world. The first of those being the Middle East and Africa. The Middle East and Africa, in our definition, is made up of a variety of markets. We cover in our forecast about half of Africa, and then also some of the larger markets in the Middle East, most notably Saudi Arabia. Dynamics are mixed this year with some of the volatility in the oil prices and how that's impacting the countries in the region. Nonetheless, based on what we've been able to see in the year to date, including, for example, trucks going into Saudi Arabia, we are expecting this year to be up compared to 2024, as you can see here. And we do expect that growth to continue in 2026. Also, just based on strong fundamentals across the region, we think the outlook is quite healthy through the 2030s, as you can see here. When we turn to South America, the growth expectation, it's the next slide, for 2025 is a little more muted. And this is because the dynamics in the region are similar to Middle East and Africa. They're a bit at odds with one another. Some countries have seen a positive impact from commodities markets developments, notably in our Andean region, which includes Chile, among others. On the other hand, we've seen that the largest market in the region, Brazil, has suffered a bit due to what's happened in the agricultural sector there. So when you look at this net, and that's the agricultural sector in Brazil has been and remains a very big driver of the truck market. So when these things come together, they sort of offset one another, and you see that our outlook for 2025 is actually rather flat, but it is showing some growth. We expect a similar dynamic in 2026. One other note is part of the reason for that sort of flat growth is actually the bus market there at the top, which is the red area, is shrinking somewhat. And this is specifically due to the end of a government program that is ending this year, that will no longer be there. And we think that that is going to be a headwind for that piece of the market. Okay. So three more real quick, just looking at the time. So mainland China, for its part, is a important story in its own right. And the real headline for China is the word resilience. Obviously, mainland China has been a very export-driven economy. It remains an export-driven economy, although the domestic market is obviously growing, not just for trucks, but for the economy as a whole. and we all know there's been some turmoil and some unexpected developments in international trade this year. Nonetheless, the Chinese economy has been performing solidly, as we showed earlier in the GDP chart. And that's really providing a good support to the truck market. And when we look at various measures of truck market health, including infrastructure spending, retail sales, and a few other things that we find correlate well with truck demand in China, those indicators are growing at a decent pace still. In addition to that, the government is providing some kinds of support to the market, direct and indirect, but they're not doing it on the scale that has been done in the past. Those of you who have been in our industry for a long time and have followed China, you know that there have been significant ups and downs in the past 10 years that have been attributable to changes in government policies, be it emission standards or scrapping schemes and things like that. Currently, there's not a large scale effort like that in place. And so the truck market is being driven rather more by fundamentals, with some supports that are shaping parts of that market, but not on such a large scale. And so we're expecting to see, I mentioned earlier that China was one of the markets that the annualized rate is pointing up slightly. So we do expect to see that to continue. We expect 2025 to be slightly up and 26 to improve further. And then we expect further growth until we sort of come up to the period where we expect to see China 7. We think that could slow the market, and we think there's also some other structural factors that may be slowing the market at the end of the forecast period. Obviously, there's uncertainties and risks with this outlook as well as all of the outlooks, but one thing that we're watching in the case of China is inventory levels. We've been noticing that manufacturing is running a little high relative to domestic demand. So far, that estimated inventory that we track is not so large as to indicate a sudden drop in the market, but it is growing, so it's something that we're watching. All right. The next two slides come back to the regions that I mentioned that are expected to be down in 2025. The first one is Europe, and the second one is going to be North America. Looking at Europe, this slide here, by the way, just shows production in Western Central Europe. It does not show Eastern Europe. Eastern Europe is expected to be down in 2025 compared to 2024, so we're expecting that slide to continue in Eastern Europe. Western Europe, I mentioned up top that we thought demand might be down, but when you look at production, you see production is expected to be up. Why is there a contrast? So the reason for that is quite simply we expect production to be a little bit ahead of demand. So as that demand trend begins to change in the positive direction, we think production will lead that trend change. Also, of course, production is geared somewhat towards exports, and we've already described some of the positive dynamics in many of the world's export regions, which will also help to lift European production. But just coming back again to 2025, there is evidence also for this view. What we've been seeing is that order intake in Europe has been improving. And we believe that that is going to change the trend in production by the fourth quarter and really begin to cause that recovery. One other point about the ongoing expansion that we're forecasting in Western Central Europe for 2026 and 2027, it's also related to some changes made in economic policy, specifically in Germany. Germany, as you may know, has lifted some of its restrictions on deficit spending, government spending. And that's going to pave the way, we believe, our economics team believes, for a longer period of or greater investment in the economy, and that specific initiative is going to help drive truck demand. So there's a few things coming together in this outlook, including evidence of what we're seeing, as well as some theory and forecasting related to what we're expecting from government policy. Okay, finally, I'd like to come to North America for the final sort of 5 or 10 minutes. And this region, as I mentioned earlier, is really one of the, I guess, one of the ones with significant questions right now. And our forecast, as you can see on this slide, basically calls for 2025 to be the second year of decline following the slide that started in 2024 after coming off the post-COVID peak in 2023. Very briefly, kind of summarizing all of the parts of the market together. What we saw in 2023 was sort of a period where manufacturing finally recovered from COVID era supply chain shortages. Manufacturers were able to increase production. They were able to produce delayed orders, get them to their customers. All of that sort of came together. In 2024, we saw that continue in the medium duty space. However, the truck tractor side really began to slide pretty hard. And you can see that on this chart with the decline in that blue line. Sort of the share of heavy trucks within the market fell, even as the market remained a little bit stronger. And that part of the market has continued to contract in 2025. And, a lot of the reason for that contraction, on the one hand, trucks were delivered and demand was satisfied. However, it's also the business conditions in trucking as a business that have become weak. Since during the COVID boom, as many of you will know, there was a great demand for trucking services. It was possible to earn very good money as a driver, as a trucking fleet. And since then, a lot of people invested in the equipment. A lot of people entered the business. And really that overcapacity that developed in trucking led to a period where freight rates, or the price that could be charged for transportation services, really fell. And since then, it's been very challenging for truckers for about 18 months or so. We are now starting to see the signs of a recovery in trucking. Although physical shipment data, we have information from many sources on things like loads shipped, shipment orders, and so on. Those are not yet turning around strongly. However, there are indications that rates, in other words, prices for shipping goods, are turning around, and we're also starting to see some measures of trucking activity improve, notably tonnage. And also, at least from one source is reporting starting to see increases in miles driven by vehicles by several fleets. So it's a transition year. Our outlook calls for conditions in trucking to improve sufficiently by 2026 to really bring back demand for heavy trucks. Again, you see that blue bar rising. And for orders to come back and for that part of the market to essentially return to health. Part of that is because capacity has fallen. We've seen some trucking companies go out of business. So the capacity in trucking has fallen. That should help to rebalance things. But part of it also comes back to the economic slides we shared earlier, showing an improving inflation profile in the United States, which we believe will ease the path to see interest rate reductions, which will ultimately, traditionally, kick off another positive truck cycle. One final comment on North America and the United States in particular. I'm going to say a little bit about some policy expectations, but one thing I need to mention here is there is an emission change planned for 2027 in the United States. We still assume that emission change will happen. And our forecast to date, and in this forecast you see here, still anticipates a little bit of a pre-buy in the truck market in 2026 ahead of that emission change. In other words, we still expect some fleets, to choose to buy a truck with the older emission standard because it will be less expensive than the newer emission standard in 2026. We'll come back to that point. It's an important point. If we go to the next couple slides, they explain our forecast a little bit more. The immediate following slide just shows the same production forecast by weight class. And there again, you can see that weakness in 2024 was caused mainly by the heavier side of the market. And then this year, we actually expect that side of the market to continue to drive that weakness. In addition to Class 8 being weak, this year, Classes 6 and 7 are also expected to be down. Class 7 is related somewhat to the same factors as Class 8, the freight environment. Class 6 is a bit different. I think the way to summarize that is it's gone through an extensive period of pent-up demand. Those vehicles have been delivered, and that part of the market is now weakening pretty quickly from what we understand. Just checking time. So the next slide shows the difference between sales and production in North America and the resulting inventory buildup that has taken place in Class 8. The reason this is important is it shows that manufacturers continue to build vehicles at a higher rate than demand for several months. So there is a stock that's been built up of trucks that is now too high and needs to be reduced. So our expectation is that in the coming quarters, we'll be seeing weakening production. And the following slide basically demonstrates some of the announcements that have been made in this respect. So we are actually seeing evidence of line rates being slowed, shifts being reduced, layoffs in some plants, workers being laid off to try to adjust production to where demand is. At the same time, one of the things I will also note very quickly is the demand outlook, which is on the right. Our outlook of about 270,000 or so Class 8 trucks for North America, you can see it remains in line with the OEM expectation. The sharp adjustment that is taking place is really happening on the production side right now. Okay, very quickly on tariffs and other questions, and then I'll hand it over to my colleague, Greg. It's no secret, obviously, the U.S. international trade ecosystem environment, whatever you want to call it, is changing dynamically. The United States has introduced new import tariffs on many goods since the start of the year. Some of them affect trucks directly, some of them indirectly. Our view, based on what we know now, is that the announced tariffs, the main impact is actually going to be indirect so far, and it's going to come via the impacts on the economy. So the cumulative impact of things like steel and aluminum tariffs, copper tariffs, tariffs on various goods from Canada and Mexico. The main impact on our truck market is going to be coming from what that does to the U.S. economy. Certainly there have been impacts. If you've been listening to the earnings releases from U.S. companies in the last quarters, many of them are talking about tariffs and margin impacts and other influences. So certainly there are impacts. But as you see at one of the first slides I showed you, U.S. economic growth still remains positive, albeit modest. So that's one impact. There are, of course, some factors that impact the truck market more directly and that drive some cost into trucks being produced in North America and in the U.S. specifically, coming through materials like steel and aluminum, as well as parts tariffs and some of the other tariffs affecting individual countries. Our expectation remains that the price impact is likely to be somewhere in the range of plus 3 to 8 percentage points versus a scenario where there had been no new tariffs. So far in the year to date, we haven't seen that much. Through the second quarter, we now have data through the second quarter. New truck prices are up, I think, just shy of 2%. I think the number is something like plus 1.9% or something like that for the second quarter. So we're not quite up in that 3 to 8% range. But it's certainly something that we're going to be watching. We're going to be looking to see if that happens in the second half of this year. So that's something to watch out for. The final thing that I will say is obviously a lot of these tariffs remain under negotiation. Currently, we're in a phase where we are seeing a variety of bilateral agreements with countries and regions around the world being made. For example, with Japan and with the European Union, to name a few. Those are settling more or less at levels that have been anticipated by our economics team. They're not settling higher generally. So I would also say that at least if they continue to develop in the way that they've been developing, then probably the economic forecast will be stable. However, there are a few that are sitting much higher than we expected, and I will name specifically tariffs on Brazil as well as India in that category. Discussions are ongoing, so those are two particular partners that we're really going to be watching to see what happens if things stay where they are or if they should come down. And obviously, though, there may be others that come up as the year progresses. Finally, the final slide I want to share is just various other questions and uncertainties related to North America. So obviously, we need to continue to watch how the tariffs develop. If those bilateral deals continue to settle around a level of around 15% or so, again, I think our economic forecast is fairly consistent with that, and our truck forecast should be fairly robust. But if things start to settle on average higher than that, then we may need to revisit the forecast. Also, obviously, there are some other questions, right? We need to see what happens with the possible commercial vehicle tariffs that are being discussed by the U.S. They were mentioned in the spring, but so far we haven't seen a decision. And of course, next year, the whole North American Free Trade Area, the USMCA, will also be renegotiated, and we have to see what happens there. Currently, our forecast does not assume a major disruption in any of these respects. But if we get a surprise, obviously we need to reevaluate what that could mean for truck demand and for truck production in the 3 North American countries as well as globally. Real quick, other things. So I mentioned already the 2027 emission standards. We just have to wait and see if anything happens. For now, our forecast assumes they remain in place. There has been a proposal to significantly cut taxes on heavy trucks in North America. So far, that has not been implemented, but it's something that we're watching. And then finally, of course, we're spending a lot of time talking to all of you, talking to our contacts, talking to others in the industry about what's happening at the plant level. Again, we are hearing that the OEMs are reducing their production rates in North America as expected. We need to continue to talk to people to see if that's taking place at the expected pace, or if the cuts are in fact faster and deeper. In which case, again, we will have to reevaluate what that means for the forecast. I hope that was a helpful sort of around the world overview of short-term and medium-term demand, as well as some of the tariff and policy questions. I'm going to hand it over to my colleague Greg now for the remainder of the session.
Hi, everyone. Thanks, Andrej. So the second half of the session, we're going to be discussing powertrain and powertrain production outlook for North America and globally. So I first want to start off here and just discuss some of the main elements of the powertrain forecast globally, with a bit of a focus on North America as well. So the first box you see, and Andrej alluded to some of this, is really this volatile policy environment. In the U.S., a big driver of future ZEV demand is this greenhouse gases regulation. This is at a potential risk. The CARB regulatory waiver, of course, the regulatory power in California is certainly at risk and being fought in the courts between some of the parties there. And those are just the start, the regulations. And we also have the zero emission vehicle incentives and subsidies, which have been drastically shortened with new legislation from the Trump administration. So there definitely is a lot going on there. Also in China, we have BEV demand is currently going pretty high. It's surging 2024 and 2025, and um, this is due in part to a lot of things, but also there's a scrapping scheme going on, which is incentivizing a bit on incentivizing to drive BEV demand moving forward. And then also the EU regulations are at risk. We think that some of these CO2 regulations are going to be altered in the near future, and that's just something we're evaluating, and it's going to be into our forecast as well. The second main box you can see here is there's really a diverse fuel type forecasts within each region, and also within the global commercial vehicle forecast. So natural gas is expected to grow pretty significantly. It has grown in mainland China. We think there's going to be a little bit of a growth in the US. This is mainly because of new products coming online, but um, also regulations as well. Diesel, despite a lot of the investment and a lot of the talk, diesel will remain the dominant fuel type over the next few decades. This is something important for us to watch, and we do expect OEMs to continue to invest and improve internal combustion engines. And then finally, the outlook for hydrogen-powered trucks globally is, I think, weakening a bit. We'll talk more about this later, but the signs there are quite drastic, and we think this is going to be delayed a bit compared to where we saw adoption a few years ago. And then finally, this final box here is really where we're connecting the dots, right? The BEV adoption has between, let's say, mainland China and the US and Europe has diverged. We're seeing growth in mainland China while challenges are still being sorted out in the US and Europe. The ZEV forecast is steepened compared to 24 months ago. And then finally, there's really been a lot of learnings from the last 24 months. Costs remain high, especially in the US and Europe. Infrastructure takes time to implement. And then finally, the battery supply chain definitely poses challenges as this starts to come online in places like the US and Europe. So moving on, I think I just wanted to touch on this quickly. These are just some of the few news and notes we have for our latest forecast. And I won't go through all of these, but you can see some of the main items here. So for Europe, that there was a big announcement from Daimler Truck. We've postponed some of their fuel cell production into the 2030s. Again, like I said, the hydrogen prospects are weakening, and that's just another sign from the market there. In Japan and Korea, we see bus ZEV production is expected to continue. And then if we move over to places like South America, the production of electric buses is also expected to accelerate here. We're always watching what types of buses and vehicles are being imported, what fuel types they have, and watching how things develop there, as well as new nameplates starting production. And then finally, in South Asia, I think it's important to discuss the government in India just launched incentives for customers to purchase electric trucks. This is something important because, again, we think purchase costs is a main challenge for battery electric truck adoption. So that's something that's happening in Europe, along with the major announcement that Iveco Group revealed that Tata Motors is set to acquire them in the near future. So always big news when global players consolidate or become partner or purchase one another. So again, those are just some key highlights of this third quarter. But again, there's always stuff we're looking at moving forward, and I'll discuss some of the North America things in more detail later in the presentation. So I do want to then also touch on some of the key messages. If we look at powertrain forecasts around the world, mainland China demand for electric trucks, has pretty much grown pretty strongly in 2024, driven in part by downward cost pressures and government actions. This market is also benefiting from battery ecosystem that's really improving thanks to the wide variety of players in this market. So it's really growing and really becoming the leader in electrification in mainland China. In Europe, we do expect, like I said, weakening regulations. We do expect them to align CO2 regulations more closely to what the domestic market conditions are. There's a wide variety of reasons for this, but however it looks, we do expect some flexibilities within the rules, which results in we do take that into consideration when we're looking at our Europe BEV forecast. And then, like I said, the divergence between the U.S., Europe, and mainland China is definitely a key takeaway here. We're seeing China just explode, purchase costs come down, so that's something that we're looking for moving forward. And then also in the United States, the Trump administration taking office in 2025 is really a game changer in the industry, and they're making significant changes within the regulatory roadmap that's reshaping trucking moving forward. And two other quick key messages I think are hydrogen. This has been downgraded significantly compared to our view a year ago. This dual ZEV strategy that we always refer to as BEV and fuel cells is definitely in jeopardy. But the main point here is that hydrogen is probably a mid 2030s to 2040s story when we think about adoption timeline compared to later this decade. And then finally, despite an era of peak uncertainty, I think, and challenges, we don't, we do expect the finish line, trying to electrify medium heavy commercial vehicles has not changed. However, there has been a delay in adoption for BEVs and fuel cells, and I'm mainly talking about the US moving forward. So let's get into some of the drivers. The first driver I want to talk about is the regulations. So we have some of the key markets here. On the left, you have truck CO2 emission standards for a lot of mainland China, Europe, Japan, and the US. And these are the biggest driver of electrification because it forces OEMs to reduce their CO2 emissions. And the biggest way to do that is selling and producing battery electric and fuel cell electric trucks. So in the graph on the left, you can see that Europe and the United States have the strictest regulations. You can see there also, I've also dotted these lines because these are in jeopardy, I believe, of changing compared to where we are today. So again, the electrification forecast follows the regulations are most stringent in the US and Europe. However, mainland China is not as stringent, but again, the ecosystem there is pretty much driving BEV demand itself in names of like cost and things like that. And then on the left-hand side, this is truck NOx emission standards. You can see significant declines, almost over 90% in a lot of these main markets. And the impact of the forecast from these regulations is really two things. One, it's an increase in purchase costs, as other hardware needs to be added to the truck, and it's also change in demand. Andrej talked about how class 8, especially, demand has been pulled into 2026 because we have a 2027 EPA standard coming online in the U.S., which is make trucks more expensive. So those are the two main, let's say, groups of regulations. And those are some of the main takeaways is how we relate it back to our forecast. And then another main driver we look at, especially in the long term, because regulations are hard to forecast in the long term, is total cost of ownership. Now, for us, total cost of ownership means anything that includes purchasing, reselling, operating, and the vehicle. So it's overall TCO, and the signpost we look for is when diesel and BEV or fuel cell or whatever other alternative fuel gets close to the TCO parity. And we look at a 6-year ownership. So a few key messages just looking at this, right? So is on the left-hand side, you have mainland China. This is for a Class 8 regional haul day cab. And you can see right away the red line, the BEV, is pretty much at parity or below that of diesel. Reasons for this include low manufacturing costs, lower battery costs, and lower electricity costs as well to fuel the vehicle, and that's really compared to a diesel truck that's a bit less inefficient compared to other markets. So you can think of a world where BEVs is just a lot cheaper to operate, and purchase costs are coming down. So that's why we have the BEVs is the cheapest option right now for this segment. And then in the other main markets, so you think Europe, Japan, and the United States, battery electric vehicle TCO is not close to diesel yet. Things like purchase costs, economies of scale. You have pretty efficient diesel trucks in these markets, so those are all playing against each other. And we see TCO for a BEV and diesel in this vocation more towards the 2030s and 2040s. And then finally, another main takeaway is hydrogen. So you can see that the purple line, which is fuel cell at the top, as well as H2 ICE, is a lot higher than the other fuel types. The reasons for this are because purchase cost is a lot higher. There's just less economies of scale. Hydrogen tanks are very expensive, and also the actual hydrogen fuel that goes into the vehicle. These are all playing a role in the hydrogen TCO, and that's why we see another signpost that adoption is probably going to be delayed into the 2030s and 2040s. And then finally, one last maybe global slide and a few others is this is the global powertrain production share. So on the left-hand side, you have trucks, and the right-hand side, you have buses. Right away on the left-hand side, you can see it's a pretty steady graph. And the biggest takeaway is that BEVs is taking share away from diesel. I talked a lot about the indicators here, and I think the main takeaway for this graph would probably be that it's not surpassing 20% share for BEV production globally by 2032. Reasons for this is because most of the production right now is in China as well as the U.S. and Europe, and there's still a lot of other global demand that is far away from electrification, just given the cost metrics as well as the regulations. And then the bus side, on the left side, you can see that the electrification is a lot further along in the bus segment. This is mainly coming from China as well as to some extent Europe, thanks to regulations as well as government actions and incentives. And if you think about, generally speaking, the bus market is likely to be shorter haul, more predictable routes, and can come home to a home base to charge each night. So a lot of these things are supporting a bus electrification, and we see this as approaching that 50% mark by 2032 globally, which is you can see a lot higher than the truck BEV share. So I'm going to go through a few quick slides, and what these next few slides represent is adoption for 2023, 2024, and our forecast for 2025. This chart shows battery electric sales share, just trucks and buses. So right away, the takeaway is you can see in the middle, Greater China is very much so surpassing Europe and North America. I talked about some of these things like cost advantage. They have a robust domestic market and ecosystem with a lot of different battery electric players and lower battery costs, and the overall cost and ecosystem is really allowing for BEV production, or excuse me, BEV sales share north of 15%. However, in Europe and North America, the story is a bit different. Infrastructure is improving, but it's still a major challenge. Startup OEMs, especially in the U.S., are facing challenges with high rates, low economies of scale. It is a high capital intensive business. That's a challenge. And then really the main one is, especially for the U.S., is there's uncertainty in the regulatory environment. So those are some of the main forces that's come to play over the last 2 years, and as we look into this year for battery electric sales share. And then I want to move to natural gas. So this is the same type of chart, but natural gas sales share. Again, mainland China is significantly higher. There was a surge in demand in 2023 and 2024. mainly due to total cost of ownership, lower natural gas prices, and a wide variety of product that's available in the market. However, we do see, you can see it's expected to come down in 2025, and we expect that to return to more normal levels throughout the forecast horizon. In Europe and as well as North America, the market has been pretty flat over the last couple of years. We're looking at 3 or 4% sales share in these markets. However, we do expect North America to grow, mainly due to regulations and then also new product coming into the market, mainly the new Cummins X15N moving forward. And then finally, we have hydrogen. So you can see that there's really limited adoption in terms of sales share for hydrogen powered vehicles. Both in Europe and North America, it's next to nothing. And then in Greater China, we're less than 1%. I talked about a lot of these things earlier, but this just goes to show you the smaller levels compared to some of the other alternatives that we're looking at moving forward. Some of the main reasons, like I said, costs, product availability, the marketplace has signaled product launches will be delayed, market sentiment, and then total cost of ownership, like I discussed earlier. And then finally, the last few slides of the presentation, I want to talk about the North American U.S. market in a little bit more detail. Right. So where are we today? The market continues to adjust to changes from the incoming Trump administration. I think Andrej alluded to a lot of this, and we discussed some of the regulations earlier. And product planning is just very challenging right now, especially from a powertrain standpoint with the future emission regulation uncertainties as we look into 2026 and 2027. As I discussed earlier, Congress passed the One Big Beautiful Bill Act. This was a new tax and spending bill, but for our purposes, the main change was it also removed a lot of Biden-era climate initiatives, such as tax incentives for clean commercial vehicles. Like I discussed, battery electric truck demand has really been stagnant over the last 24 months, with hydrogen ecosystem, hydrogen adoption, and momentum really lagging even further behind that. So there's a lot going on. A lot of it's on the policy side, but also we're watching the market develop and move as we go into the second half of later this year and into 2026. A big piece of the puzzle really is what I'm showing here is the regulatory roadmap. This is, we really today do have a complete set of regulations, namely NOx, CO2, and ZEV requirements. And what I want to talk about here is really on the next slide. So you can see that this is sort of where we're at today. And the next slide I've labeled in these gray boxes with red text is that the regulations that have changed or at risk of changing. So pretty much everything is at risk of changing. Not everything will, but it's important to note that there's discussions and proposals to change a lot of this. We talked about the NOx regulation in 2026. That's going to have an impact on the demand in 2026, as well as a demand in 2027, new engines coming to market. And then in the middle there, you have the greenhouse gas phase 3, which is a big driver of ZEV demand as well. This is a similar graph as we showed earlier. This is just for North America, and I think a lot of the main messages are also in this graph, which is North America production by fuel type. And right away, you can see that we do see a growth of electrification, almost to 10% by 2032. The reason it's not higher are some of the ones I've outlined. Regulations and costs and infrastructure are the main issues. And then hydrogen is obviously even smaller sliver than that, is just 1% out to 2032. I want to end on talking about what else are we watching. I think there's a lot of changes and uncertainty we're staying on top of. Looking at the rest of 2025, such as hybridization, will electrified products be included, mainly for regulatory compliance? So this could be, a challenge moving forward. Policy changes. What's next for the Trump administration? There's always something around the corner. So we're looking at the regulations Andrej talked about tariffs, and then also the OEM investment direction moving forward and talking about some of these. As far as the fuel types, we're also looking at hydrogen. I think it's well known that this is going to be delayed compared to what expectations were, 1 or 2 years ago. But will this even be a solution in the long term? And that's something we're looking at as well. So I do want to end and just give a quick plug on our. This was referenced earlier in the presentation, is our Reinventing the Truck report, which will be published later this year. And it's really a long-term strategic report looking at the four main global markets that I discussed today: mainland China, the U.S., Europe, and Japan. And we have a wide variety of insights, such as long-term sales, TCO, regulatory insights, and a lot of other analysis on the global sales and in park and how that's going to develop from a powertrain perspective. So with that, we thank you for listening. I think we will we're going to probably skip Q&A, but I'll give it back to Miki to close us out.
OK。はい、皆様ご清聴いただきありがとうございました。あとちょっと時間がオーバーしているんですけれども、ぜひこの中央型商用車予測サービスにご興味がございますかというこのA か B でお答えいただければと思います。はい。で、今日はちょっと時間がオーバーしてしまいましたので、質疑応答、質問をたくさんいただきありがとうございます。後日、メールでご連絡させていただきます。で、次の次回のウェブご案内をさせていただきます。9月の24日に弊社松原からSDB の OEM の準備状況とアプローチの比較というタイトルでウェブナーを開催いたしますので、ぜひご参加ください。今日はどうもありがとうございました。